880,000 people lost a Medicare plan. That's UnitedHealth's own Medicare Advantage book, measured from the end of last year to the end of June. It's on the company's filed membership table. In the same 6 months, its medical care ratio improved by 2.7 points. Its health insurance segment nearly doubled its operating margin over that same stretch. 3 weeks ago, it emerged the company is looking at 34 more counties across 12 states. And it did all of that while the government was paying it more, not less. So here's the question this video answers. A health insurer just fixed its margin without making a single treatment cheaper. How do you do that, and who has to be removed for the arithmetic to work? You know this product, even if you've never held the card. It's the plan your parent chose at a kitchen table in the fall, off a mailer with a smiling couple on it. Dental included. A gym membership. A card for groceries. It costs $0 a month, which is the part nobody quite believes the first time they hear it. That offer was real, and it was built on one rule. Medicare pays a private insurer a fixed amount per member per year, and the insurer keeps whatever it doesn't spend on care. Take that spread and hand some of it back as extras, and you win the kitchen table. And for a while, it worked. Insurers call the key number the medical care ratio. It's the share of every premium dollar that goes back out as care. 3 years ago, UnitedHealth's sat in the low 80s. Then it stopped working. Watch that line climb across the 3 years. Almost 6 points of margin gone in 2. 6 points on that revenue base is real money. And I want to be honest about it up front. This company had a broken book, and something had to be done about it. So when the plans started disappearing, the explanation everyone reached for was the obvious one. Costs went up, the government cut what it pays, the insurers had no choice. That story isn't a fringe theory either. The company tells it itself. But the record of what the government paid says something the funding story can't survive. Start with what a Medicare Advantage plan is, because it decides everything after this. It isn't one national product. The payment is set county by county, so profitability isn't an average the company manages. It's a separate piece of arithmetic in every county, and it gets resolved every year. We don't have to infer that. It's a sentence in the annual report. Read that again, because it's the whole film. Annually, county by county, where we will offer. That's not a company describing something that happened to it. That's a company describing a decision it makes on a schedule. So here's the investigation. 4 steps. Step 1. What the lever does. When the arithmetic in a county stops working, an insurer has 2 options. Lower the cost of the care it authorizes, which is slow and hard, or stop offering the plan there, which takes a filing. The second one is faster, and the filings say it's the one that got used. In the risk factors, the company writes that it has ceased to offer benefit plans in certain counties. And here's the tell. That sentence is in the risk factors. The risk factors are where a company writes down what might go wrong. This one used the space to record what it had already done. It listed those county exits beside cost management as a management tool, which is exactly what they are. Step 2. What came off the map? For plan year 2026, the company shrank its individual Medicare Advantage map. It stopped offering those plans in 109 fewer counties and in 1 fewer state. 2 different groups of people sat inside that decision, and they are not the same group. About 180,000 members were in the counties that were exited. Separately, more than 100 plan options were discontinued, and those held about 600,000 members. I have to attribute both of those precisely because the film's own standard requires it. Those two member counts are reported company statements. They don't appear in any filing we could find, and we looked in 4 of them. The membership table is a filing, though, and it's where the size of this shows up. Step 3. What the removal did to the ratio. Follow the book down. 8.4 million members at the end of last year, 7.5 million by March, 7.5 million in June. That's a drop of 880,000 in 6 months off the pure Medicare Advantage book. Now, put the ratio next to it. That's the medical care ratio again, and it improved 2.7 points year over year in the latest quarter. The company explains the connection itself, and it uses 4 words that carry the entire mechanism. Medical costs went down, it says, primarily due to fewer people served. That's the machine in one line. Not a treatment got cheaper, fewer people served. And I want to put a number on what that was worth because a ratio is easy to wave away. So, take the quarter's premium revenue, multiply it by that 2.7-point improvement, you get about $2.35 billion. That is, medical cost the company did not incur in a single quarter. $2.35 billion in 3 months. And here's the number underneath it that almost nobody checked. Because there's a thing people assume about a business that shrinks, and it's wrong here. You'd expect the revenue to fall with the members. It didn't. The company's quarterly revenue went up. Fewer members, more money, better ratio. Those 3 things are supposed to be incompatible, and the filing states all 3. One correction I owe you, and this next chart carries it. Watch the premium line, not the revenue line. The premiums themselves fell about 1% year over year. The revenue that rose is the whole enterprise, and it rose on other businesses. Nobody here is selling more insurance. Which leaves one thing unexplained. The company gave a reason for all of this, and the reason is checkable. Step 4. The reason they gave. The defense is on the record, and it names a specific cause. The chief executive of the company's government programs business said this about the 2026 reductions. Funding cuts. That's the claim. So, we went and read what the funding did from the agency that sets it. Both plan years are on this chart. Watch which side of 0 the bars sit on. For the first year, Medicare finalized an increase priced in the tens of billions. For the second year, an increase again. The headline mark is the smaller one. The mark beside it counts the risk score trend, and it is roughly double. Payments went up. In both of the years, the plans came off the map. And it gets sharper because the company put its complaint in writing and the regulator answered it. In the annual report filed in March, UnitedHealth called the following year's proposed rate far below the industry's forward cost trend. 5 weeks later, the final rate came out, and it was higher than the proposal. Here is that complaint, pinned to the earlier of the 2 marks it was arguing about. 4 months after that final number landed, the preliminary list of 34 more counties surfaced. And notice what that sequence rules out. The exits can't be a reaction to the rate because the rate was already known, and it had gone up. They can only be a judgment about which counties clear the bar at the payment on offer. So, the causality everyone assumed runs backwards. It isn't that the money fell and the plans followed. The money rose in both years, and the plans came off anyway. The county map was never a response to a squeeze. It's a choice about which counties are worth serving at the price on offer. Remade every year on a schedule exactly as the filing says. That's the deselection, not a cost that came down, but a population that came off. And the honest version of that has a limit I need to state plainly. It's worth about a third of the number I just gave you. $860 million of that quarter's improvement is a net favorable reserve adjustment. The company says that adjustment relates mostly to this year's dates of service, so it's 37% of the $2.35 billion, and it is not members removed. It's the insurer's own estimate of what care would cost, coming in better than booked. The remaining 63% is what the deselection and the pricing levers together account for. And two more limits briefly. The company's own full-year forecast for that ratio is worse than the quarter I just showed you. So this is the best print of a year the company expects to end harder. And a rate increase smaller than your own cost growth is still a genuine squeeze on margin. Payments rose, and they exited anyway, is what the record says. It does not say anybody lied. So let's do the ledger. Every step of this was lawful and filed. The segment captured it. Look at the captured side of this ledger. UnitedHealthcare's operating margin roughly doubled, and its earnings did the same. That is the health insurance segment, not the whole company. Shareholders captured some of it. The buyback line underneath it is billions already spent through mid-July, against a larger number targeted for the year. The members lost the plan, and here is the part of that loss most people don't know, which is a structural fact about the program itself. A Medicare Advantage plan has to cap what you pay out of pocket in a year. Once you hit the cap, the plan covers the rest. Original Medicare, the thing you fall back to, has no yearly cap at all, unless you buy something separately that supplies one. So, the protection the plan supplied doesn't exist in the program they fall back to, unless they buy it. That's a statement about how the program is built. It isn't a claim about what happened to anybody, and nobody has published that. And the market did the same thing. Humana says its own 2027 exits will affect roughly 600,000 of its members. Different company, different members, coincidentally, similar number. Which is how you know this is the design responding, not one company's stumble. There is one more number worth knowing, and it belongs to the whole market rather than to this company. Across Medicare Advantage, the share of members forced to switch plans used to run about 1% a year. It went to just under 7 and then to 10. Smaller insurers accounted for almost half of that. That's the industry, not this insurer. It's here because the lever isn't unusual anymore. The insurer's exit is annual, and it's on a form. The member's health is neither, and the enrollment window closes. So here's what I'd like to know. You've now seen the filing. Say it out loud. Does a county exit read to you as an ordinary business decision, or as something a company should have to explain to the people in that county first? And there's a second half to this. That preliminary list becomes official on the 1st of October, county by county. That's its own story.